Good morning from London. I'm Anna Edwards alongside Guy Johnson and Kriti Gupta. We're an hour away from the opening trade. Here's what you need to know. President-elect Trump picks Elon Musk and entrepreneur Vivek Ramaswamy to lead a new department aimed at dismantling, quote, government bureaucracy. US and European futures are lower, with the dollar continuing its rally as traders weigh Donald Trump's agenda. We'll look ahead to US inflation data. Plus, Germany's snap election campaign ramps up, with Olaf Scholz making his case later today for another term as Chancellor.
In the meantime, a quick check on these markets. As Anna mentioned, we are seeing risk sentiment tilted to the downside when it comes to futures. Eurostoxx 50 futures down about 0.6%. The FTSE 100 slight outperformance, higher by 0.1%, marginally in the green. The bond market gets interesting. 443 on the 10-year in the U.S. ahead of that CPI report, and of course that's having an effect on dollar yen, which, by the way, we are now at a 155 handle there. Currency intervention back on the table. The countdown to the opening trade starts right now.
Wednesday the 13th, good morning. I can't work out what the word of the day is. It's either still Trump, and I think the cabinet story I think is fascinating, or it's inflation. The two probably overlap when it comes to the dollar. Kriti just analysing what is going on there. And the huge pickup we continue to see in the buck. Where does the buck stop? I think probably is the question that a lot of people are going to be asking themselves around the world. But this cabinet is already, Kriti, looking fascinating. Some of the names that are being brought in, are you up for a job maybe within the cabinet?
I don't know. They just got a Fox News host. Maybe that's my next step. Who knows? It's a really interesting one, though. I mean, I think a lot of the attention is going to Elon Musk and Vivek Ramaswamy on this Department for Government Efficiency, which, by the way, doesn't currently exist. This is something that they would create, so the parameters around it. Some are calling it that this is Doge and some sort of play on the crypto. Of course, President-elect Trump has not confirmed that that's what the initials stand for, but a happy coincidence for those who believe in it. Other nominees to me are quite interesting, though. A lot of pro-Israeli stance when it comes to some of the Middle Eastern officials. Mike Huckabee, the former governor of Arkansas, the U.S. ambassador to Israel. Several crucial players when it comes to defense, CIA, and, of course, special envoy as well. So the ceasefire talks that have been ongoing, there's a big question about where that goes next.
Yeah, absolutely. So big impacts in the Middle East. In terms of what this does around markets, you know, Trump and Ramaswamy may be getting the attention. Special guest employee is the way that Musk is going to be described, which avoids him having to resign, crucially, from all of the other business interests that he has, or many of them, Tesla, SpaceX, for example. You did see so. I mean, Tesla stock has no doubt been a big beneficiary of Trump so far, but it did wobble a little yesterday, and you wonder whether we're getting into that period where we start to ask questions about how much saving $2 trillion from the government's costs is going to distract him from
I also wonder whether it's wobbling a little bit, and the broader market's wobbling a little bit, because we don't know who's going to be at the DOJ yet. And I think that's going to be really interesting. Who's going to replace Lina Khan? Are we going to see maybe a continuation of actually the anti-M&A story that came out of the Biden administration? Wall Street's all abuzz at the moment, and the fact that we're going to see more deals coming through. But in reality, is that going to be the case? This has been one of the big drivers of the Trump trade thus far. Yeah, and we certainly have some. An interview with Wall Street, banks talking about that. Jane Fraser talking about that, don't we? Let's talk about markets and where we are there, because there's some interesting points of continuity and also new dynamics to mention. So Asia stocks under pressure, a 2-month low. No surprise when the market seems to be focusing on the Trump appointments around China, the tariffs impact that might have. The dollar continues to climb. We saw Treasury yields going higher yesterday. Maybe that's another factor that might start to weigh on stocks at some point if we do see continued concerns around inflation and that higher yield story. We have a lot of froth in certain asset classes, Bitcoin being one of them. Colleagues putting together a chart with Bitcoin, SPACs, profitless tech, all of that doing very well, incidentally, over the last few weeks or so. So a lot going on in markets as we wait for that CPI print later.
And, of course, the CPI print having an effect already we saw this morning on dollar yen. 155 handle there as we're talking about that weakness brings back the Asian story, the intervention risk. If we start to see this narrative of strong dollar, yen, among many others, are due to suffer.
How do you make Germany great again? Honestly, this is the question that I think we've now got to wrestle with. America apparently is taking care of itself. Germany has now got to ask that question. We're going to see Olaf Scholz today in the Bundestag. He's going to be making an address. There is going to be a debate. Friedrich Merz is going to be giving, I think at around 8:15 this morning, UK, 9:15 Germany time, an address at the Süddeutsche Zeitung conference. We're going to hear what he has to say. Germany has an identity crisis. Germany has an economic crisis. Germany's got to figure out what it does next. Are we going to start to get maybe some flesh being put on the bones today by some of these parties today on how they're going to do it? Is Scholz the right man to lead, or the right person to lead this country forward? There's so many questions here. How do you make Germany great again? I think is a question that I think we all need to be thinking about.
Yes, and we'll have some guests later on in the programme, won't we, to talk about the prospect for the CDU in the forthcoming election. We now have dates, though, December 16th for the confidence vote. February, we have to wait until then to get that the actual election on the 23rd. We have heard from the finance minister, though, for what it's worth in the interim, cookies, talking about there isn't a funding freeze. Government can still function, even though it might be quite difficult to get their 2025 budget through.
Economic confidence in Germany is at rock bottom. You see in all the IFO, ZEW, everything is just basically pointing at lows. And you can see that really clearly.
It's a really fascinating one. I'm curious how this all shakes out for the euro. 106.14 is where we're at on euro dollar. Sensitive to data, but maybe not sensitive to politics at the moment.
It does seem that way, doesn't it? It'll be interesting to see whether or not you get, if you were to see a positive outcome, you see some clarity coming out of Germany, whether you get an uptick on that or whether the dollar is simply too strong. We've got a great lineup coming up on the show today. We've got some great guests. Let's talk about who we're going to be speaking to throughout the next couple of hours. Jens Stoltenberg, former NATO Secretary General, is going to be joining us exclusively. Freddie Lake, Managing Partner at Latitude Investment Management, talking about what he sees in these markets. How does he trade the Trump story? What does he see in Europe? Laura Coady, Global Head of CLOs and Head of International Securitized Markets Group at Jefferies, is going to be joining us. The interest rate story absolutely front and centre at the moment, Anna, in so many ways. ABN Amro, one of those cases.
Absolutely. So what do interest rate expectations tell us about net interest income in the banking sector? We'll certainly get to that conversation now. We've had the numbers come through from ABN Amro, the Dutch bank. Interest income and impairment releases driving a beat when it comes to the profits. Interesting lines about buybacks. We'll get to that in a moment. But let's start this conversation then. We're joined now by the CFO of ABN Amro. Ferdinand Vaandrager is with us this morning. Ferdinand, nice to speak to you. Let me start with the strengths that you're reporting. So net interest income has been one of the factors that has helped you beat estimates. On net interest income, how do you see that progressing from here? We have expectations that the ECB cuts interest rates, and that might eat into your ability to drive profits there.
Yeah, thanks for the question. Number one, profits clearly for this quarter good at 690 million, and a big driver of that is resilient net interest income, where on one hand you see our overall asset and liability margins holding up quite well, and at the same time our treasury result is still benefiting from higher interest rates. If we look forward, the forward curves are quite volatile, but also at lower interest rates, we expect to maintain healthy margins and good profitability. And it's also in terms of outlook, our modelled deposits are managed in a replicating portfolio, and as said, the treasury result is still benefiting from the interest rate. So it's also some effects which are balancing each other out that we think it will remain at rather healthy levels.
OK, so Ferdinand, so you're saying that net interest income is resilient now, and even in a lower interest rate environment, margins and profits will hold up in a way that you're comfortable with. And so why are you saying what you're saying today about buybacks? You're saying that the potential room, the capital position means that the potential room for share buybacks has been postponed to when you present your second quarter results. Talk us through the rationale there.
Yes, we said earlier that we will have annual assessment on our overall capital position and decide then if there's any room for a potential share buyback program. We're in the middle of simplifying the last part of our credit risk models, and at the same time preparing for Basel IV regulation. As both are coming at the same time, it's a complex process which takes longer than expected. And in order to do a proper assessment, we would need to take some prudent assumptions for these implementation uncertainties. So rather than base it on that at Q4, we decided to put the evaluation moment to Q2 next year. Number one, it will then be based on formal Basel IV numbers, because that will be reported as of Q1. And secondly, we will most likely by then have concluded our acquisition of Hauck Aufhäuser Lampe as well, which we expect to close in the second quarter of next year.
Morning, it's Guy, Ferdinand. Let's talk a little bit about costs. Yes. Costs are up. a little bit. That's maybe a weak point in this set of numbers. Is that a one-time hit? Is that something that you think is going to be coming down from here?
No, costs are okay, correct, but it's also not unexpected. Number one, we concluded a collective labor agreement for 2 years over the summer, and we also did some additional hiring. It's quite a tight labor market, so there was a bit of a delay in that. So both of them resulted in costs being up if you compare it to previous year and compared to the previous quarter. But we still stick to our overall guidance of around 5.3 billion for the full year. So yes, it's up, but it's fully in line with expectation.
Can I just ask you a broader question? We are seeing maybe some cross-border M&A taking place. Now, the government has a significant stake in your business. What happens to that stake going forward? Do you see any kinds of lessons learned from what is happening with Commerzbank right now?
We're always in a very good dialogue with the NLFI, which holds the government-owned shares. We recently had a new government, but they're very consistent in saying that they want to fully privatize ABN Amro. And they also announced a few weeks ago that they start a new trading plan in order to reduce their stake from 40% to around 30%. The last two trading plans took around 8 months. So they're gradually selling shares in a prudent manner in the market. So I don't see any sort of comparisons with the transactions being done in Germany.
You're confident you know who's buying that stock?
Well, the shares are being sold in the market, and clearly we're always looking at what our shareholder register is. But we have a very healthy shareholder register, and we've seen in a previous sell down of around 10% that there's a healthy appetite to pick up the flow which comes to the market.
Ferdinand, I want to talk as well about kind of the capital buffer rules as well. There was, of course, an election in the United States. One of the impacts of that could mean a change in some of the buffer rules around the U.S., making American banks even more competitive in Europe. Do you see that kind of landscape, that regulatory landscape in Europe changing in response, perhaps, to what we're seeing in the States?
No, I think if you look to the latest statements of Claudia Boeg, I think that's absolutely not on the cards. What we did have seen is a delay of fundamental review of the trading books, which will have an impact. For us, that's a negative, because going to simplified approaches is for us a benefit. But for now, we don't expect any delay in Europe. Clearly, it will have an impact if you're going to look in terms of competitiveness, if both sides are diverging from each other. But I think it's too early to have a conclusion about that.
Ferdinand, do we read anything into the fact that you've seen releases, or you've been able to give us releases from your impairments reserve? So you were expecting more bad loans than you actually saw. Tell us about how that fits with a sluggish Eurozone economy right now.
Yes, what you've seen for this quarter, there was a release of impairments of 29 million. It also means, if you look year to date, that we have a negative cost of risk. And we have, through the cycle, cost of risk guidance of between the 15 and 20 basis points. What you're actually seeing here is really demonstration of a high quality of our loan book. And it's also a result of significant de-risking we have done over the past few years. So it's really evidencing the underlying strong quality. And yes, do we expect at a certain moment a gradual normalization of towards our through the cycle cost of risk indication? Yes, but as said, we expect that to be a gradual process, and the credit quality indicators forward looking are still looking very healthy.
Thank you very much, Ferdinand. Good to speak to you. ABN AMRO CFO Ferdinand van der Ager with us this morning to talk about the business and its results and the outlook for rates and the European economy. Coming up on the programme, we'll dive into the markets as traders await the macro strategist Henry Allen joins us next. We'll get his analysis. This is Bloomberg.
the more the Fed cuts, the more you're lifting your hand off that lever to hold inflation down. Layer on top of that, what might be, some of the new administration's policies that are, that sound inflationary. It's very hard to say that inflation is beaten or inflation is over. That doesn't mean inflation is going to run away. It just means we're going to have to live with a higher rate environment for a lot longer.
That, of course, Apollo co-president Scott Kleinman speaking to Bloomberg, talking about inflation. We get CPI data out a little bit later on. Henry Allen, macro strategist at Deutsche Bank, sitting around the table with us this morning. How much of that do you agree with?
I think it's a good line, actually, because even before Trump's election, we had a lot of inflationary risks. I mean, let's not forget the backdrop is one where central banks right around the world are already easing policy. And many of them, like the Fed, are doing so in an environment where inflation is already still slightly above target. It's in the twos. It's not back at 2.0% just yet. And we know that monetary policy operates with a lag. Then you add on top of that the risk of tariffs in the next few years and then fiscal stimulus. So I think, if you were trying to build up an inflationary recipe, it's pretty similar to what we're seeing right now.
How much does that undermine the case that this is 2016 2.0?
I think it does, because I think too many clients, and I'm warning this to people, are using the 2016 playbook. But back in 2016, inflation was lower, and also unemployment was higher. So there was more spare capacity in the economy to absorb things like fiscal stimulus, which just isn't the case now. I mean, another thing I've said is, 2016 is as close to the global financial crisis as it is to today. We were still in that low-rate world of the 2010s. Fed funds rate when Trump was elected in 2016 was still beneath 0.5%. 10-year treasuries were around, just over 2%. They're now, 4.5% nearly. So this is a very, very different environment, and valuations are a lot more stretched today. So expecting that kind of market reaction to be the same as it was in 2016 looks like a stretch.
But there is still a lot of liquidity sloshing around in the system, as some of our guests would say. And I think it's fascinating if you were to, say, look at the Fed's balance sheet and the stock market, there's still plenty of room to go. It's a chart that's widely circulated. Why is it not just simply a liquidity story?
Well, I think, firstly, obviously, the Fed is still doing QT, so, some of that is draining still. But, I mean, another point we've been making is, in the 18 months before the 2016 election, the S&P 500 was only up 1%. There was a lot of room for catch-up, because 2015, early 2016 were not great years. In the last 18 months, we have seen the most phenomenal rally, up 45% over the last 18 months. So this is a very, very different context, and we've got to bear that in mind. So there just simply isn't that room to grow in the same way, particularly when you consider valuation metrics like the Cape, for instance, are at much more elevated levels than they were back in 2016.
So if not the U.S., then where? Where do you put your money?
So paradoxically, I think the US is still the best bet, given, I know, the debate you were having earlier on the programme about places like Europe and the skyrocketing growth problems they've got there, particularly given China's weakness under the tariff threat. I just think that, in terms of where things are going next, the US is still the best bet. It's just on a relative basis, you're not necessarily going to see the relentless rally that we have for the last couple of years.
So the US is the place to be then, Henry, but we'll get inflation and we'll get growth in the US, will we? So how do you play that? What's the best play for that environment?
Well, I think one thing to be very cautious on rates right now, because, we've said, we think, plausibly in the near term rates can rise to 4.6%, but, there's definitely upside risks on that because, you've got the tariffs coming in, you've got fiscal stimulus coming down the tracks. It's worth bearing in mind as well that the debt to GDP ratio under, now Trump's presidency it's going to be, is forecast to exceed its post-World War II high in the next 4 years. So we're in an environment that is uncharted territory for the US. So I would be very, very cautious on the rates market right now. And I'd also fade, expectations that the Fed are going to be cutting rates very rapidly. We've been warning about that for some time. The market has been pricing in an environment where there isn't going to be a recession, inflation is going to be subdued, and the Fed are going to cut rates very, very rapidly. But that feels just, too good to be true.
We seem to have moved on, don't we? In just the last couple of weeks, we've gone from pricing 4 cuts by the summer of next year to just 2. Is that the end of it? Or do we get to a point where we're starting to price in a pause earlier than that?
I think we could start to price in a pause. I think the big question is going to be what is the timing of any tariffs that come in, because something I'm conscious of is in Trump's first term, he didn't really start pursuing the trade war in earnest until the second year of his presidency. And Fed Chair Powell himself has said, we're not going to assume what policy is going to be. We're going to react to that. So actually, if Trump opens with a kind of negotiation phase, doesn't impose tariffs instantly, it could still be some months, maybe a year or so, before we see a bigger market reaction to that. But then again, if he starts doing that instantly and uses it as an instant leverage play, then clearly we've got to react a lot quicker.
Bears have been beaten up. a lot recently in the stock market. Some of the most sort of senior bears that are out there have decided to go back into hibernation or leave their jobs. I'm wondering how tough it is to be bearish. Like, this is a world that feels like it, particularly America, that wants to be on the front foot. The dollar's on the rise. Trump's back in. The Trump trade is back on. There's an expectation that Wall Street's going to be buzzing again with M&A deals. When you talk to clients, what do they say about being bearish right now? What is the pushback that you get to being bearish and being concerned about what is happening in terms of valuations and inflation and all these sort of things? Are they broadly on board, or is everybody still all in?
Well, I think they're on board when I give them the bearish arguments. I think what burns them more is just all their experience since 2009 betting against the S&P have generally not played off for a decade and a half now.
Stocks always go up, according to Kriti.
Yeah, I mean, that's...
I'm sure that's a paraphrase.
Yes.
I may be paraphrasing.
Show me a stock chart that isn't going up, Guy.
That's definitely the pattern. But as we were saying, when the CAPE ratio, just to take one example, has been this high in the past, you had the dot-com bubble. That did not end well. You had 2021. Also, that was followed in 2022 by a 25% correction in the S&P 500. Now, I think the question is, we have seen scenarios like the dot-com bubble where this can carry on for some time, maybe upwards of a year plus. But the risk is there some catalyst? A bit like we saw in late 2021, early 2022. If, for instance, inflation came back and then you're back into a higher rates for longer world, could that be the catalyst for then a correction to take place? Because, we've seen an absolutely relentless historic rally. It's going to be the first time since the dot-com bubble, probably, that the S&P 500 posted back-to-back annual gains above 20%. Haven't seen that since the 1990s. Even in the 2010s, never got that fast.
So Guy makes a good point, though, in that one of the bear cases for the S&P 500 is the dollar. Simply so many international investors, to your point, have been kind of saying there is no other place to put your money besides the United States. But how low does, say, the euro or the pound have to drop to incentivize the reverse fund flow?
Well, we think the euro could go down to parity, particularly in an environment where there was a more aggressive trade war from Trump, particularly as we think, the ECB are going to have to react to that. And in turn, we think they're going to lower their deposit rate all the way down to 1.5%. So that's going to, in turn, if we're right on this, open up a big interest rate differential that the market isn't quite pricing yet.
Does that incentivize equity funds back into Europe, though?
I think it could do in time. I think it might take a bit. The question is, can Germany and some of these other countries kind of get their growth in order? But I think there's optimism there as well. I mean, I heard your segment just before this, but I was reminded of the fact that, between 2001 to 2005, German growth was basically flat for 4 years and then went on to a very strong performance in the 2010s. So there's nothing kind of inevitable about this stagnation continuing. It could just take a bit of time.
Certainly something we're going to be keeping our eye on. A 106 handle on euro-dollar this morning. Henry Allen, macro strategist over at Deutsche Bank, joining us around the table this morning. A couple of headlines collapsing in the Bloomberg terminal as we were speaking around Thames Water securing a Class A creditor backing for their rescue plan. This is a plan to raise about £3 billion in emergency funding. It required about 75% of a threshold for those class creditors to meet the minimum requirement to implement a plan in the UK courts. It looks like they did actually get that initial approval. The final approval still depends on a legal ruling. A lot of courts involved. We're expecting for that initial hearing to happen on December 17th. So, of course, we will keep our eyes on that. And, of course, how the bonds trade in response.
This emergency funding is only a short-term solution. I'm reminded by our story this morning. Thames Water still needing to address its debt and secure an additional more than £3 billion in equity to fix the infrastructure issues and to cope with climate change.
Yeah. Higher bills, more inflation. That's certainly going to be a story coming out of the utilities. It's going to be really interesting to see how that works. Olaf Scholz is having to deal with an election. How's he going to deal with that? We're going to find out later today. He's going to give a key speech in the Bundestag. That's next. This is Bloomberg.
Welcome back. This is the opening trade. It is Wednesday morning, everybody, 7:30 here in London. So 30 minutes until we start equity trading in the cash market. The futures picture then looks a little mixed, actually, for Europe. At least the FTSE 100 looks as if it might go its own way, possibly even the DAX, but that's not looking quite so assured. The CAC 40, though, could be under a little bit of pressure. US futures do look a little negative. We certainly see Nasdaq futures on the back foot this morning, down by 0.3%. When we look at the bond markets, we have US bond yields still heading higher. We were having a conversation about about 4.5, 4.6 on the US 10-year. We've had conversations about much higher. And we're not even back to sort of peak summer levels for 10-year yields stateside, but 4.43 is where we trade. And European yields are ticking a little bit higher. There's a lot to get into the European bond markets right now. There's the US politics. There's also some domestic German politics very much at risk of influencing what goes on with Bund. So the German election campaign will kick into high gear today, with Chancellor Olaf Scholz making his case for another term in a key speech. Let's bring in Bloomberg's Oliver Crook in Berlin. So, Ollie, good morning. We're expecting that Scholz speaks and that he has quite a tough crowd to win over as he does so. What are we expecting to hear?
Yeah, and I think it's fair to say he's got a pretty tough crowd. And this is really his first speech since we've got the actual timeline of this election, which, just to remind everybody, is February 23rd is the federal election, brought forward almost by a full year by this collapse of the German government. So he goes before the Bundestag today, gives a 30-minute speech, which will then be followed by a 2-hour debate, which is really anticipated to be extremely fiery, very tense. Obviously, the politics of Germany are extremely tense right now, made even worse by the sort of economic situation that we've got in Germany, and really these sort of very conflicting ideas of how to solve that problem. And what we'll have from Olaf Scholz is he'll have the opportunity, despite sort of getting a lot of criticism, which, as we're anticipating, to sort of reiterate his platform and what his plan is and why he should be given another shot to fix the economy. And really the main difference that we're going to have between him and Friedrich Merz, which increasingly is where the focus is going towards, is Olaf Scholz is really wanting to spend more money, really sort of get rid of that debt brake, but also do it in a much more equitable fashion. He's much more concerned with sort of social benefits, the social welfare state, and the sort of and those kinds of issues, and pensions, where we were seeing really a contrast from Friedrich Merz. The other issue I think that is on the horizon for many German voters, I don't know how much this plays into the actual polls, but this is really a sort of definitive question. On the horizon, you have Donald Trump. There is no secret that Olaf Scholz and Donald Trump really will not get along particularly well. Olaf Scholz basically said very openly that he was more in favor of Joe Biden. So this is going to be one of the key issues, particularly going into this election.
Friedrich Merz is going to be speaking at the Süddeutsche Zeitung event a little bit later on today. What's the pitch? What is he saying about how he would do things differently?
Yeah, so what's interesting about Friedrich Merz, who, we should say that just in the last 20 years, the polling has always been the CDU as #1, with a very short period of time for those 6 months when the last vote was held and the SPD was elected. So this is a structurally much more favorable environment for the CDU, and he's polling in #1. We heard him speak yesterday. We're going to keep hearing from him over the next few days. He said that #1 for his agenda is going to be tax reform in Germany. This is going to be sort of welcome news for the big corporations. He says he will not raise taxes on individuals. He wants to cut bureaucracy. He wants to cut benefits. We should say that basically every German politician since always says they're going to cut bureaucracy. Whether or not that happens is a separate question. But the other question, this is a key question for this vote, is being very restrictive on migration. He's more conservative than Angela Merkel on this, and he's really hoping to take some of the vote away from the extreme right and the extreme left on this issue of immigration. And the final point, the point of Ukraine, he has really been much more supportive of being much less restrictive on the arms that are being given to Ukraine and striking within Russia. The Taurus missiles, for example, Scholz has refused to give over to the Ukrainians. This is something he will change, he says, immediately. Plus, he wants to add even more spending on the defense. Right now, Germany spends about $50 billion. He wants to bring that to $80 billion. Of course, the key question is, how do you pay for it? And that will get to I think the fundamental issue here is the debt brake. Could you see that eventually reformed?
All right, Bloomberg's Oliver Crook, of course, covering that for us out of Berlin. We thank you so much. And sticking with, of course, the elections around the world, Donald Trump's victory in the United States election has become a major talking point at the COP29 climate summit in Baku. Bloomberg asked key figures at COP what the president-elect could mean for global climate policies, trade, and more. Take a listen.
We won an election, respect that vote, and let's start thinking about what he does as compared to what we all think he will do. That speculation isn't going to get us anywhere.
First of all, let's see what President-elect Trump will actually do. I do hope that we won't see a repeat of the U.S. leaving, the Paris agreement.
We don't set our business plans based on the political agendas or who's in the White House or what party's in control.
And of course, there will be challenges. Tariffs can be a challenge. Climate issues can be a challenge, but the truth is that throughout history, the United States and Europe have usually seen eye to eye, and I'm sure we'll be doing that again in the next 4 years.
Well, the transatlantic relationship is strategic for Europe and for the US, I would say. And so we have every interest in finding win-win solutions, having a constructive relationship.
The trade war would be bad both for the US and for Europe. I do think there is a possibility on the US-European relationship to work with President Trump and to find a win-win.
It seems then that an incoming President Trump will have a lot to say and make an impact on those who are thinking about the climate. And we're already seeing, of course, that markets have been responding to his re-election. Joining us now to think about that, Rachel Evans, Bloomberg's managing editor for FX and rates coverage for the US and EMEA. Rachel, so let's talk about the markets in 3 minutes. And the big thing that lies ahead, US CPI, can that cut through, do you think, this very in-the-moment CPI reading? Will that cut through when really the markets are just obsessed with Trump and how inflationary his policies are going to be?
Yeah, I think it does because it speaks to that. If we do see sort of a hotter than anticipated reading today, we're expected to see about 3.3%, I think, on the kind of core inflation year-on-year figure. If we do see that becoming in hotter than expected, that does kind of like sort of give a higher base, I guess, as we go into a Trump administration, which could, again, add to inflationary pressures. So people are really kind of closely watching this. At the moment, there's a bit of a question mark about how much the Fed can cut, and they're not even necessarily pricing into their forecasts yet some of these inflationary policies coming through from Trump. They're looking at inflation, they're looking at the labour market. So I think if we do see kind of sort of an inflationary figure that is away from expectations, either on the hotter or weaker side of things, that could kind of move the needle and sort of actually make its way into the mainstream.
Let's talk about the dollar and ask my favourite question. Where does the buck stop?
It's a good question. We have keep hitting highs after highs. We were back to another one-year high on BBVA'S and the main kind of dollar index yesterday. We're seeing that push down the yen. We're seeing that push down the pound. The yen is going to be a really interesting place to watch because we are now back in that intervention level. We saw the yen kind of moving through 155 earlier this morning in Asia hours. So I think that's going to be really interesting because it kind of really sort of raises the temperature for policymakers around the world. But the question of where it can stop is an interesting one. I think it's going to come down to this sort of push-pull between monetary policy and fiscal policy that we're going to be seeing play out over the next sort of 6-12 months. If we do see kind of Trump come in with more fiscally inflationary policies, that slows down monetary policy and means that the dollar can stay strong. But if we do see, for example, this inflation print suggesting that actually, the Fed can go faster, then maybe we kind of see the dollar sort of ease off a little bit in the short term.
You're already seeing that in terms of the weakness that you're seeing in the yen, at least this morning as well. But I'm going to ask the flip question of Guy, that if you continue to see this dollar strength and parity with the euro, certainly in conversation, how weak can the euro fall?
Yeah, I mean, I've started to see sort of like, 95 cents as kind of like something that people have been saying, so moving through parity. Wow. If we do see kind of tariffs sort of like coming through in force. So we're obviously around 106 at the moment, so that would be a significant move. But that's, if the stars align for a weaker European kind of markets weaken as well. I think the other thing, though, to watch is US stocks. They're starting to get very, very pressured by higher yields, by the dollar. We really did sort of start to see kind of like that rise up in stocks easing off a little bit yesterday, and there's a question mark about how high yields need to go before they really start to put kind of the pressure on real estate stocks in particular.
Are you hearing 95 from a lot of people?
It's starting to come through in a few analyst notes as like a out there scenario, but I'll keep you posted.
Okay.
All right.
Wow.
Rachel Evans, going to keep us posted. Bloomberg's managing editor for FX and rates coverage for the U.S. and EMEA. We thank you so much. Coming up on the program, we're going to talk about the future of NATO. We're going to bring you an exclusive interview with former Secretary General Jens Stoltenberg. That conversation next. This is Bloomberg. We are about 18 minutes and change, maybe 17 minutes and change, if I can do my math right, away from the opening trade. We are seeing futures a little bit mixed here. Your Stoxx 50 futures have actually paired their earlier loss and now down only 0.1%. About an hour ago, they were down by almost 1% as well. So that is actually quite a big turnaround. Some outperformance in the FTSE 100 continues higher by about 0.3%. It looks like futures in France and Germany are also turning positive as well. Again, a real turnaround in the last 43 minutes or so that we have been on air. We'll see how that sets us up for the opening trades across Europe. I'm also going to point out that the IBEX continues to be under pressure, and this might have something to do with the fact that in the last 24 hours we did get an official ruling coming from the CNMC, the antitrust authority there in Spain, addressing the BBVA bid for Sabadell. It looks like that review is going to be taking even longer than expected, facing months of extra competition review, as they say, confirming, by the way, an earlier Bloomberg report from our colleagues over in Madrid. You can see in yesterday's trade, those stocks dropped quite substantially. A couple weeks ago, we had an exclusive conversation with both sides of that deal, with BBVA CFO and the Sabadell CEO. Take a listen to what they had to say about the state of the deal.
We do think that this deal will go through with no competition issues, authorization from the CNMC with no structural remedies. That's what we're seeing today. Unfortunately, as you say, time goes by. Time is, as Carlos mentioned, is something that is not good for the deal, and we acknowledge that.
For them, time is not helping because the performance of our stock in relative terms is significantly superior. Time doesn't help them. That's true.
Time doesn't help, and suddenly time is all they have on the agenda.
Yeah, absolutely. So now the regulators, as you say, putting this out for review, and more time will be taken. So will the deal last is one of the crucial things. We'll have to wait months now to see whether we actually get this one coming to pass. Excuse me, 7:44 here in London. Let's pivot to geopolitics and Western security, very much on the agenda at the UBS European Conference in London. Bloomberg's Francine Lacroix is there for us with a guest. Fran.
Yeah, thank you so much, Anne. I'm delighted to be joined by Jens Stoltenberg, the former NATO Secretary General. Mr. Stoltenberg, thank you for joining us. I mean, for the next 6 months, I think markets, security experts, world leaders will try and figure out what Trump 2.0 means for world security, world peace, and, of course, the economy. You've dealt with him in the past, sometimes in a great manner. Sometimes I know it was fraught discussions. What do you think the best way to deal with Mr. Trump is?
I think the best way is to actually address the issues that he raises. And in NATO, we made a decision in 2016 to engage with then the incoming Trump administration. We did so for 4 years, and I had a good working relationship with him. That doesn't mean that we agreed on all issues, but the main message was that European allies had to spend more, and we addressed that. It was a message on China, the consequence for our security, and also on Russian gas. So we decided to engage to address the issues, and I think that's the best way also this time.
I mean, sometimes he uses actually language that is very disparaging. Is that hurtful for relations, or do you have to just look beyond that?
He has a different style, but again, I think we need to focus, and that's what we did and I did, was to focus on the substance. And again, the main message was that it was unfair that the United States paid 3-4% of GDP on defense, while many other European NATO allies and Canada spent 1 plus something. And this has been a message from many US presidents. It was actually President Obama that forced through the decision in 2014 in NATO to increase defense spending to 2% of GDP. At that time, only 3 allies spent 2% of GDP on defense. This year, 23 allies are spending 2% of GDP on defense. So this has really changed for many reasons, but also because of the clear message from President Trump when he was in office last time.
How worried are you about Ukraine? The fact that they may not get enough funds, they may not get enough weapons, but also that there is always a risk that Donald Trump sides with Russia.
So we all want this war to end. At the same time, we know that the quickest way to end the war is to lose a war. But that will not bring peace. That will bring occupation of Ukraine. And it will make the whole world more dangerous, because the message then to President Putin, but also to other authoritarian leaders, is that when they use force, when they invade another country, they get what they want. So it's in our security interest to ensure that Ukraine prevails. So the challenge is to end the war in a way that doesn't lead to occupation, but to end the war in a way where Ukraine prevails as a sovereign, independent nation. At some stage, there has to be some kind of political negotiated solution, but we know what happens around the negotiating table is so closely linked to the strength on the battlefield. So if we want a negotiated solution to the war where Ukraine prevails as a democratic state in Europe, then we need to provide military support to Ukraine.
But so what does that look like, that solution? And is there a danger that the U.S. actually, manages to cobble something together, some kind of agreement, without the guarantee from the U.S. side of Ukraine's sovereignty?
Well, it's for the Ukrainians to decide what will be or would be an acceptable solution. But there has to be at least two elements. One is a line agreed. But second, when such a line is agreed, then we need to ensure that actually it stops there. Because we have agreed, or the Ukrainians have agreed lines with Russia before. When they annexed Crimea back in 2014, we had something called Minsk I. There was a line, then Russia violated that, and we got Minsk II, a line further west. And then the Russians waited for 7 years and invaded full-scale Ukraine. So we cannot have what I call Minsk III, yet another line, which is not respected. So when a line is agreed, we need some kind of guarantee that Russia doesn't continue after reorganizing their troops, and therefore we need either to arm the Ukrainians so they can deter future aggression themselves, and or some kind of security guarantees, and NATO membership is of course the ultimate security guarantee for Ukraine.
But, Mr. Stoltenberg, do you think we're closer to an agreement, or are we closer to peace under President Trump, or are we further away from peace?
I'm certain that President Trump and his administration would like to find a way to end this war. And of course, my message will be that they have to find a way to end the war which respects the sovereignty and the interest of Ukraine. That is also in our interest. Second, when I worked with President Trump last time he was president, then I remember that actually he made, and his administration made, an important decision to start to deliver lethal aid to Ukraine, weapons to Ukraine. That was not NATO policy up till then. And in 2017 or 18, the decision was taken to start to deliver, for instance, javelins, the anti-tank weapons that proved so extremely important. So the message is we need to strengthen Ukraine to enable a negotiated peaceful solution. I don't think we can change Putin's mind. His aim is to control Ukraine, but I think we can change his calculus, that the price he pays for controlling Ukraine is too high, so he has to accept something where Ukraine prevails. I
mean, there are about 10,000 North Korean troops invited by Russia at the Ukrainian border. What do you make of that?
It demonstrates that security is not longer regional, security is global. As the former Japanese Prime Minister Kishida said, what happens in Ukraine today can happen in Asia tomorrow. And we see how Iran, North Korea, but also China are in different ways supporting Russia. Yeah. Iran with missiles, drones, North Korea with ammunition, enormous amounts of ammunition, but also soldiers. Yeah. So it demonstrates that we need to have a global perspective of what happens in Ukraine. It matters for global security, and therefore it makes it even more important to support Ukraine.
I mean, whether people like or don't like Donald Trump, he's certainly more unpredictable than a certain other administration. Does that make the world safer? Because people without the rule of law will be more careful in challenging the U.S., or does it make it less safe?
I will be careful speculating too much before we have seen actually what the new incoming administration will do. Again, I think that NATO allies, other partners around the world have to sit down and engage with the new administration and actually address the issues they are concerned about. That's the way we work in NATO, have worked for many years. And if you're concerned about climate or trade or security, sit down, discuss those issues. And sometimes there are actually issues that we can solve together.
Mr. Stoltenberg, thank you so much for joining us. That was Jens Stoltenberg, the former NATO Secretary General, with some very powerful words about how world leaders should actually deal with Donald Trump going forward.
All right, Francine Lacqua there, of course, at that UBS conference, as she said, speaking with the former NATO Secretary General. This is a conversation we're hearing over and over again in the European dialogue, in that what does a Trump 2.0 mean, of course, for Ukraine, especially when the French delegation and the French government has been really trying to dig into the idea that there is no solution that includes a secession of territory, et cetera. The only solution is to invest in your defense. And it feels like that narrative has really created a tailwind for a lot of the defense stocks, even more so than we've seen in the last couple of years.
Friedrich Merz, we were just hearing from Ollie talking about maybe increasing the German defence budget from 50 to 80 billion. That would certainly provide a significant tailwind, and you replicate that elsewhere. Yeah. Maybe actually there is even if you did get a peace deal in Ukraine, a significant tailwind that's going to carry on for quite some time.
It is really interesting to see that, Europe is facing up to this reality that it has to fund its own defence more and more. That we saw under the first Trump administration. Very heavily made point, and again, we're seeing that playing out this time around. That doesn't necessarily mean that within NATO or even outside of the NATO structure that Europe has its own policy on Ukraine, and we'll have to see just how much it can diverge or is willing to diverge from US policy.
But if you want to have a voice at the table, if you want to have a seat at the table, you have to be able to defend yourselves. And you do wonder if Europe were able to say to the United States, say to the Trump administration, we are able to defend ourselves. How does that change other spheres of influence that are being pushed at the moment by Trump? Does it change trade? Does it change all these other things?
How transactional are all these things?
Precisely.
That's always the question that we asked right back in 2016, and we'll continue to ask it, I'm sure, for the next 4 years. A little more in the here and now, in the next 4 minutes, in fact. In around 6 minutes, we'll have the open of European trade futures looking flat to negative across European stocks. US futures, though, looking a little negative. A lot to factor in later on in the day when we get the CPI print, and as Rachel was telling us, it could push in the same direction as some of those Trump trades.
It absolutely could, and it feels like there's that relationship between the bond market and the stock market that we need to pay attention to. Again, if you do start to see a more pronounced sell-off in the bond market, as Anna was pointing to, 443 on the 10-year, what is the ripple effect on not just the stock market, but other risk-on assets as well? Coming up, it is the opening trade across Europe. Futures mixed. This is Bloomberg.
Wednesday morning, good morning. It's interesting, European futures aren't that positive this morning. In theory, if you look at this chart, they should be a little bit more positive. We got the Trump speed bump yesterday, and we saw a little bit of a fade as the morning progressed over in the United States. The European markets, to a certain extent, mirrored that, but then we get a bounce in the afternoon session, which we're not really pricing in this morning. So that's the kind of the legacy of yesterday. We've seen a really strong run for US equities. That's beginning to fade maybe a little bit. Europe feels like it's on a very different path right now, and we don't price that bump in, Kriti. What are futures looking like?
Well, a little bit mixed, and it's been the last hour. You've seen a complete turnaround on that momentum, perhaps reflecting that exact dynamic that you were talking about. An hour ago, we were doing this futures check, and Anna, Eurostock 50 futures are down almost 0.7%, a complete turnaround story. The outperformance remains in the UK, however. IBEX is going to be interesting. Remember, we do have that CNMC review that came out in the last 24 hours. Hasn't been priced into the markets yet. Keep an eye on banking stocks, Anna, in the Spanish index.
We will keep an eye on the banking sector then, certainly over in Spain and beyond with those numbers out of ABN Amro. Some other stocks that we'll watch out for then, Kriti. Let's talk about Just Eat Takeaway. Wonder Group is buying Just Eat's Grubhub. That for around $650 million. That is a real discount to the $7.3 billion price tag that it commanded during the early days of the pandemic. So something of a turnaround there. Siemens Energy really in focus as well, increasing their medium-term targets as they continue to try and turn their backs on the issues they had around Gamesa, their wind business. Those were legacy issues. Could they be walking into further issues, though, with the Trump administration? The wind sector still reeling to some degree from that. So grid technology, a more positive story there. RWE in focus as well. A buyback plan there, Guy, and that could move the share price.
Absolutely. So some single stocks definitely to watch out for this morning. It's going to be interesting to see, though, what the index trade does look like. We are seeing a lot of caution around Europe at the moment. We are seeing some serious concerns. German politics is but one of them, but there's other issues that we need to be factoring in. The FTSE 100 is, though, out of the gate this morning with the opening trade a little bit more positive. We're up by 1/10%, but let's see how the other markets fare this morning and see what gets priced in there, because the Stock 600 continues to fade. We're down by about 1/10% this morning, a little less than that. So not a great deal of movement. Let's take a look at Kriti's IBEX, down by 0.2%. The banks are going to be front and centre there as well. CAC's down by 1/10%. To be honest, I don't think you can actually read much in at an index level. So let's find out what's going on below the index level. Kriti.
Guy, it almost feels like a reversal of yesterday's trade. Yet again, this idea that tech is actually the underperformer this morning. ASML and SAP are your two biggest weights, at least on the early trades, for the Stock 600. And the rest of the sectors, you are seeing a little bit of a mixed picture. Banks are the outperformers. Your biggest one of your biggest contributors to the upside, Anna, is HSBC as well. So to me, it kind of feels like the cyclicals may be outperforming today. tech, the defensives, underperforming.
Yeah, that could be something we're watching for. We saw a real underperformance yesterday from the basic resources sector, and there again is another area of reversal today. So the basic resource sector from the worst performing yesterday to, lo and behold, the best performer today, up by 0.7%. In terms of those stocks on the move, Kriti, you've been through some of those for us already on the tech sector. AstraZeneca, then, a stock we talked about quite a lot yesterday, and that stock up by 1.9%. Rio Tinto, part of that rebound that we see in the basic resource space. So a few interesting movers there in terms of the individual stocks. In terms of the companies that have reported, ABN Amro, I can see, is down by 1.7%. We were speaking to the business earlier on. They seem to beat along the top line a lot, but there was that kind of caution around returning cash to shareholders, and I wonder if that's weighing on expectations.
It feels like it might have a read-through across the banking sector. I want to quickly point out that UBS is, of course, under pressure as well. And just in the last 24 hours, you did have a Reuters report coming out that the U.S. is probing Russian accounts that U.S. had taken over from Credit Suisse. I'm curious how much of that is affecting the volatility that we're seeing. Those shares down about 1.2% in the opening trade. We're going to keep an eye on the DAX as well as we start to continue to get those trades. But in the meantime, I feel like the big picture story is bullish or bearish on U.S. equities. We spoke to Louise Dudley, Global Equities Portfolio Manager at Federated Hermes. Take a listen to what she had to say.
The US for next year and beyond is actually looking very strong, and even within Europe, we're looking at companies that have that US exposure. The growth is just that much better.
Let's bring in Freddie Late, Managing Partner, Latitude Investment Management, joining us around the table this morning. Freddie, we keep having this debate. Guy and I are up in arms about it, whether the stock market always goes up or not. What is this reaction to the Trump trade? Is this an extension of maybe the outperformance, the economic resilience we already saw, or is there something different?
Morning. I think, it is extraordinary how it does just keep going up. So that's a fact at the moment. I was just saying before the set, it surprised me how much it moved higher, given it had rallied so far into the numbers. And so I was a bit shocked by that. The difficult thing here is this does drive growth. There is a chance for more productivity, more deregulation, more M&A, more activity, more domestic production. So there are reasons to be more incrementally bullish on the US economy as a result of the election. But a lot of that was already in the price, and this is really what the big question comes down to, and why I think we're seeing the volatility between sectors and rotations going on, because actually the economy is very strong, but so is the market. It's already anticipated that in a large way.
When it comes to anticipating that, though, what kind of correction, what kind of downside are we looking at here? Is this maybe something when the inevitable pullback comes, which we know is a function of stock market rallies, are we looking at mini corrections, 5-10%, or something a little scarier?
I think it really depends what causes it. And I know that's a get-out-of-jail-free answer. But
Come on, Freddie.
if it's inflation, I think it could be quite meaningful. If inflation is driving a real reset in capital allocation and people pulling back and a drying up of liquidity across the board, then you won't have that support to buy back into the sort of the dips, if you like. Obviously, the same thing applies if it's a meaningful recession, but that does feel reasonably unlikely at the moment. The underlying economy is pretty strong. The third reason why it could be weaker, and I do think it comes down to this liquidity point, is if other areas of the world start looking genuinely rosier. And so if liquidity leads the US market at the same time as we're seeing a correction and says, well, actually the UK or Japan or emerging markets or any other region are really interesting, we're going to deploy our liquidity and capital elsewhere, that would stop the dip buyers being ever present.
It doesn't feel like the rest of the world looks rosier, though, at the moment, does it?
No, not at all. So it doesn't feel like inflation's coming back. It doesn't feel like the rest of the world is rosy. It does feel like the US economy is getting a little bit better. In fact, it's quite strong. Inflation's contained. Employment's high. And so you can see why US exceptionalism continues as a trade.
Let's talk about where you're putting money in the bond market.
Yep.
Long-dated inflation-linked bonds.
Yep.
10%. Is that presumably that's an inflation trade?
It's an inflation trade.
Short-dated yields 12%, short-dated bonds 27%.
Yeah.
Is that just a cash-like story, or is that a belief that rates are coming down?
That's principally a cash-like story. So the way we've been looking at the government bond markets, and we think about European, UK, US, inflation-linked or not, long duration or not. And we have predominantly been short-dated, call it cash, for the last couple of years. And we've been pouring our way into a little bit of the longer-dated inflation-linked bonds in the US, where I see the inflation risk as the highest. Not today. Today it's it's at 2 and a bit, and break-evens are at 2 and a bit, 2.3, I think. But the risk is really there that it could pick back up again. And I would look at the Trump win and think that became more likely. But because interest rates have risen, the duration effect has swamped that. So the bonds are losing money at the moment, but even the inflation-linked bonds.
why is that normal for you? Short-dated gilts, short-dated bonds, 27%, 12% and 27%. That cash-like story. Is that cash-like story there to take advantage of something, or because actually short-dated yields are, let's call it circa 5%, and that just is decent ballast into a portfolio that's risk-free?
Yeah, it's not been that normal over the last sort of 10 years, but in the last couple of years it's been very normal, yeah. And I think you've got an inverted yield curve, so you get paid more to take less risk in many ways. And it's optionality on something happening, as you say. I don't know which way we could go, deflation, reflation, lack of liquidity, but the chance for increased volatility in both the bond and equity markets feels so high that the optionality of owning cash versus duration seems very good to me.
So we're talking here about whether your asset allocation across different asset classes is Trump-proof, I suppose, and whether the inflation risk is there and whether you're protected. What about in your equity holdings then, Freddie? I noticed quite a lot of bank stocks represented here, some other financials. Is this part of a Trump trade? Is that where you see the positivity?
So we did have our third best day ever after the Trump's election, but it wasn't because we positioned for it per se. I've owned a major overweight in the US banks for the last 8.5 years. So that's been in the portfolio. We've sized it up and down. We did add a small amount into the election, but it's not positioning around macro events. It's not really how we do things. We're trying to look at the world and say, where's the value? Where's the world going to be in the next 2 to 3 years' time? And try to position for that, not around the short term. So it's working very well. I do believe we'll continue to see the rotation, out of some of the big cap tech names, not necessarily meaning they have to crash, but just meaning there are so many other things that might be more interesting for investors.
Freddie, I'm interested in your view on this, whether or not it is something that you get involved with. I think it's fascinating to think about cryptocurrencies and where they go under a Trump administration. So tell us how you're thinking about this, because the extent of investor or institutional adoption of Bitcoin as we go into another Trump administration, with the change in regulations he might bring, the bringing onshore data, crypto mining and all sorts, is this something you give thought to, or you let others do this?
So we haven't invested in crypto or the crypto ecosystem. Obviously, I look at it and follow it a fair bit, but there's far more in the world that we don't do than we do, if you like. So, I don't do small caps, I don't do private equity, I don't do private credit. So we follow it, and it's interesting, and it fascinates me on weekends for reading, but it doesn't impact many of my stocks. To a degree, it impacts some of the banking shares. They could either be beneficiaries or losers from it. It impacts my utility shares because that, along with AI, drives massive demand for electricity in the US if it does get reshored. So there's some sort of gentle benefits in the portfolio.
So it doesn't drive any kind of fundamental rethink of crypto and its worth and its prospects because we end up with another Trump presidency? It might do for others.
It might do for others, and I can certainly see how the day before to the day after, you've got to say it's worth more, given his positivity towards it, and he's talking it up, and the involvement of Elon Musk in the sort of, in the government in its own form. So it had to be worth more to some degree. Valuing it's obviously famously challenging, but valuing gold is challenging too, and I've invested in gold. So it's not, I'm not sort of completely anti it. It's just, we need a little bit longer to get used to it.
So we keep talking about the Trump trade, but what about the Biden unwind? The massive kind of over-indexing to chip stocks, for example, as a form of defense. What happens to that bid?
I think it gets rotated into other assets. These stocks are great, but they were generally pretty expensive coming into it. And stocks like JP Morgan, which was up 12% on the day, is trading quite expensive compared to its history, but it's on sort of 12, 13 times earnings. Which isn't 30, 40 times earnings. And it still grows at 15% as well. Is cyclical, of course, but it's incredibly robust. Fortress balance sheet, Jamie Dimon would tell you. And there's plenty of other things in retail, in healthcare, in utilities that we think are on 15, 16, 18 times, growing that sort of rate. Often much more defensive as well, which can be a benefit. I just think the rotation can carry on for a number of years. It'll come in fits and starts, but I really think this is just the start.
You got Ryanair in the portfolio?
Recently, yeah.
Why did you make that decision? The stock's been rising for a little bit off its recent lows. The company screwed up its relationship with its travel agents. It's had a problem with Boeing. There's been pricing kind of issues, how much capacity there is in the European market. Why is now the right time to get back in?
Yeah, so the three of those things are quite connected. Yeah, we've never invested before. We've been looking at it for about 5 years, contemplating investing. And the stock went up and down, basically sideways. The shortage of the plane deliveries from Boeing is only a good thing. You know, buying the supply cut in airlines tends to be a good thing because fewer planes means higher prices, higher profits. The issues with OTAs, online travel agents, has been solved. They've all come back to them now. And it was that switch from turning them off to bringing them back on better terms that led to the pricing lack of transparency, which led to the issues. So now that that's fixed, we're entering a higher price environment if we maintain a strong economy in particular in Europe.
How important is that?
It's pretty important.
So it's a macro play?
In the short term, it's very much a macro play, like investing in a bank. But over the next 5 to 10 years, I just think it's a structural play. It and Delta are pretty much the only two developed market airlines that make any money. It's going to continue to take market share. It has a potential to yield up on its passenger numbers. It's kept fares flat in nominal terms for 15 years. Pretty amazing. 42 euros.
Yeah, it's the way they run the business is different to everybody else in terms of the way they yield and pricing. Freddie, nice to see you.
Very good to see you too.
Indeed. Freddie Lake, Managing Partner at Latitude Investment Management. Thank you very much. Let's take a quick look at the Core 6, see what's happening at the centre of gravity here in Europe this morning. This is what the picture looks like. And as you can see, it's a fairly mixed one. LVMH rebounding from yesterday. As Kriti said earlier on, we're basically seeing in some ways a reversal of what the trade was yesterday. Novo's a little soft this morning, but not by much. Nestle's a little soft this morning, but not by much. Europe kind of feels like it's drifting a little bit sideways, but there is action elsewhere. And Joe Easton brings it to us.
Huge jump in Just Eat Takeaway this morning, which is traded in both London and Amsterdam. Now, the company offloading its Grubhub business. They announced that deal just a few moments ago following a report last night. Now, as Anna mentioned earlier, it's a massive discount to what they paid for the business just around 3 years ago. They're selling it for around 650 million euros versus a $7 billion price that they announced back in 2021. But the company has been hit by a fee cap over in New York, limiting the amount of money they are allowed to charge for deliveries, and also competition from Uber Eats as well. So analysts and investors really keen for the company to get out of that one. As I say, up 20%, a big move for that stock. Then in renewables today, we've got a couple of stories. Siemens Energy, didn't expect it to be up as much as that. That's a big jump for that one as well. Now, the company announcing strength in its electric grid business. Weakness still in the wind energy part in Gamesa. That has been the problem for the stock. But that is the best performing stock on the entire stock 600 this year, up a couple of 100% in terms of the year-to-date gain for that one. Then RWE announcing a share buyback. This follows pressure from Elliott, the US activist investor, just last week said that the company should be doing a buyback when he announced a stake in the company from the investment manager over in the US. So both those stocks rallying this morning. Smiths Group, meanwhile, wasn't so much on the radar. This is a UK-listed engineer, does detection and also oil and gas supplies for the UK company. That one rallying, following much better than expected organic growth for the company today. Then over in banking, the big news out of Spain was this in-depth probe on the takeover of Banco Sabadell by BBVA. Now, that seemed a little bit procedural when we first looked at that report, but according to analysts over at BI, this means the takeover could potentially be delayed according to their analysis. Remember, BBVA did have that hit from the US election, given their exposure to Mexico and concern around a potential trade war there. So that stock and also BBVA in focus today as well. Then in terms of ratings changes, Jefferies becoming more negative on chemicals given the cyclical outlook downturn. There's K&S is an underperform, and Kepler Chevron has a big note on European software today, downgrading a bunch of stocks, including Bechtel, a €5 billion company over in Germany. That one is declining as well as Kepler gives it a sell today.
Thanks, Joe. Joe Easton with an update on some of those individual movers this morning. And there are plenty of them, it would seem. Not a hugely busy day for earnings, but quite a few substantial movers on the block this morning. Let's just tell you that we are getting some live pictures coming to us from the NATO headquarters. NATO Secretary-General Mark Rutte and US Secretary of State Antony Blinken are delivering remarks in Brussels. We're monitoring these live pictures. No headlines coming through just yet, but we know that they are set to talk about Ukraine, of course, ahead of Trump's presidency. When we come back, we'll continue our conversations about some of the stocks that are substantially on the move this morning. Siemens Energy boosts its midterm targets on growing demand for its grid technologies. More on that next. This is Bloomberg.
We have a backlog now of 123 billion. To your question on our midterm targets, this helps fuel the future. We're very confident not only with how much we have in our backlog and what we're serving with our customers, but also the margin quality. And we're very pleased in terms of our targets for this year. We've either met or exceeded in all areas, and this really makes the basis or fuels the basis, if you will, for the future.
Siemens Energy CFO Maria Ferrero speaking there to Bloomberg Television a little earlier on this morning. A little bit of context. This is a stock that started the year in January at 12. It's now trading this morning at 46. It's up by 20% this morning. We'll talk about Bitcoin in a moment, but this kind of feels like it's almost Bitcoin in its rally that we are seeing. It's raising its midterm targets, strong demand for grid technologies. Bloomberg's Will Mathis joins us now for more. I was trying to check out the short interest as well, which has been picking up a little bit recently, but this is a stock that's had an incredible run so far this year and a big spike higher today as well. This isn't about wind, though. This isn't about a recovery in wind, and it's not a Trump trade. This is about grid technology and gas.
Yeah, if anything, this is about the company making people forget about the wind business, which is still losing money. Yeah. But the other parts of the business that have always been strong are doing so well that it doesn't really matter that the wind business is losing money and will continue to do in the next fiscal year. But the other businesses are strong and put the company in a really good position.
So tell us more about the opportunities in grid technology then. I mean, you can't move for stories about data centers in the United States right now. And maybe, I don't know what the Trump administration means for that. Maybe it supercharges some of it. What expectations do we have there? Well, because on the other side of the agenda, on the wind agenda, that could be negative for a business like Siemens Energy.
Yeah, I mean, in Europe, in the U.S., there's a huge need to update the electric grid. And there's it's difficult to win in the wind technology, even in solar technology, but in grids, it's relatively simple. These companies have been doing it for a long time, and all of a sudden, everyone wants to go from just maintaining the grid a little bit to growing exponentially. And companies like Siemens Energy are very well placed to do that, and they don't have a lot of competition. There's not a lot of other players out there. GE Vernova in the U.S. is another one, similar, one of their only peers, really, and they've also done tremendously this year. So you see this as a trend in the energy sector, that companies like this that know how to build grids can deliver on time and at scale that governments need are really profiting right now.
Well, Will, a big chunk of the demand for renewables is coming from tech players, from data centers, et cetera, et cetera. Is there a trade-off, and you kind of hinted at this, between powering some of that demand via wind as opposed to solar, especially with the new administration? What does that trade-off look like?
Yeah, and I mean, the other part of Siemens' business that's doing really well right now is the gas business. And, you know, these tech companies don't just need clean power. They want clean power, but they need reliable power. They need power all the time. And when the wind isn't blowing and the sun isn't shining, increasingly, both in the U.S. and Europe, gas is what's filling in that gap. So even as you have a transition to renewables, you're also having a boost to gas, and Siemens is there to benefit from that.
Certainly something we're going to be keeping a very, very close eye on. I know the President of the United States certainly is talking about electricity prices, for example, going off the charts. Bloomberg's Will Mathis talking to us a little bit about renewables and, of course, the massive move we're seeing in Siemens Energy this morning. And speaking of massive moves, let's talk about an asset that may be taking a little bit of a breather. Bitcoin cooling after a post-Trump rally drove the cryptocurrency to just under $90,000. For more, let's bring in Bloomberg senior editor for digital finance, Anna Herrera, joins us around the table. So we know the Trump trade is a big chunk of this. Has it gone too far?
We'll have to see how fast the government, the new government, the incoming government, acts on crypto. I think the industry expects them to move really fast, but you'd have to think they have other more pressing matters. And obviously, we've seen the rally. Probably it's because of the big contrast with what we've had with regulators so far. They've been really, I guess we could say, aggressive towards crypto, especially in the wake of all those collapses. And so just the idea of perhaps having a new administration is making everyone very excited.
What is the case for this, though? Is it, as you say, maybe less regulation, more ETFs? Is it that the US is suddenly going to be adding to its own stock of Bitcoin? What is the core of the case surrounding higher Bitcoin?
I think for a long time, the industry has expected institutions to come in. And now with current regulators, perhaps banks and bigger players were a bit worried to come in. Now, if you have friendlier regulators, then it makes it easier for traditional financial players to come in earnest. So we've had BlackRock. We have had big players with ETFs, but you haven't seen dealers come in. So if you expect a world in which, the SEC is more friendly, then you can see the banks or any other major players come in, and then there will be more demand for assets like Bitcoin.
What does a strategic Bitcoin stockpile mean and look like for the United States? Because that seems to be one of the things that people are getting, trying to read the tea leaves on, whether the Trump administration will try to build one up.
I don't know, maybe we'd have to ask El Salvador because they had a stockpile. I guess it's just, any case for more buying of Bitcoin, because obviously it's finite, then you'd think there's more demand and so the price could go up.
And linking back to our last conversation about grids, there's also talk that Trump wants to bring onshore some of the mining activity. Is that a likely prospect?
It depends. There has been some mining in the U.S. compared to other countries because the electricity could be, cheaper. But obviously, it depends on where it goes. They're just excited about everything in general. So I don't know if it's better to be not excited and then be happy rather than the other way around. But
boundless excitement from the world of crypto. Wonderful. Thank you very much, Bloomberg Senior Editor for Digital Finance, Anna Herrera, on set with us this morning, trying to make sense of this big rally we have seen, and then a slight cooling on the Bitcoin share price as it got to those lofty levels. Now, let's talk about another area of excitement in markets. Will we see more IPOs? Klarna has taken its first step towards a US IPO. The Swedish payment platform has confidentially submitted a draft registration statement to the SEC, the Securities and Exchange Commission. The number of shares to be offered and the price range have not yet been determined, and all eyes will no doubt be on the valuation that this business manages to get to. Implied by a recent asset sale, according to Deutsche Bank, this business is worth about $14.6 billion US dollars. Bloomberg reporting it could be $20 billion US dollars, or that's what it will. Sorry, our colleagues reporting that that's what it could have been aiming for. I'm interested in the regulatory landscape. Is there a Trump play involved in this? Do they feel that the regulatory regime will be lighter on a buy now, pay later business under Trump?
And we haven't seen an economic cycle. Are we about to see an economic cycle? When does that cycle kick in, and how does that affect this entire sector, buy now, pay later? Also, you do wonder kind of what is happening here with the European listings. Here's another one, potentially going to the United States.
Europe.
Swedish company. Off they go, better valuations, etc.
It speaks as well to the idea of what these valuations even come in at. Because this Klarna is still very much seen as a little bit of a startup. It's not necessarily as much of an established company as some of its other peers. And I believe Northvolt was a great example where the startup momentum was very large and then just completely fell off a cliff. I think that'll happen with Klarna, but who knows?
Yeah, your point, Guy, really interesting, because if everything wants to be a tech company, and if tech companies get better valuations in the United States, where does that leave Europe? When we come back, we will have an interesting conversation about another part of the market that we don't talk about very often. Issuance of collateralized loan obligations have skyrocketed this year. Will that continue? This is Bloomberg.
This is the opening trade. We're about 30 minutes into today's session, seeing a little bit of a mixed picture, a little bit of a retracement when it comes to kind of the losses that we saw in the futures picture. Green on the screen for most of the indexes, but not by a massive margin. Seeing a little bit of pressure still on the Euro Stoxx 50 down. We'll call it 0.1%, being generous, but we'll call it flat just to be safe. Just Eat Takeaway seems to be one of the exceptions, though. Those shares soaring to the tune of over 20% after the food delivery company sells its Grubhub unit to Wonder Group for $650 million. Let's bring in Bloomberg's Charlotte Hugh Morgan to walk us through the deal.
Thank you, Kriti. Yes, so this is big news today for Just Eat. This is a deal that its shareholders have been going after for years. It first announced in 2022 that it was trying to sell Grubhub, but it has been quite a challenge for it. So that explains the kind of huge share price jump we saw at the open. A bit more on the details. So, as you mentioned, it's $650 million to Wonder Group, which is the startup led by former Walmart exec Mark Law. Now, just on the context here, that's a huge discount to the 7.3 billion price tag that Grubhub commanded back in 2021. You know, peak of the pandemic, you had these food delivery companies, share prices absolutely soaring, you know, people ordering so much takeaway. But I think, you know, that valuation drop is a real indicator of how food delivery companies like Grubhub have, you know, struggled to maintain that momentum.
And so tell us more about why shares then, Charlotte, have reacted as strongly as they have. Because if there was... I read this story this morning and thought, oh, well, people will be disappointed at the fact that it's worth so much less than it used to be. But clearly that's not the story.
Totally. I mean, I think it's just the market breathing a sigh of relief that the deal's finally kind of gone through. You know, as I said, this has been really in the works for a long time. And you had, you know, Just Eat CEO saying this will improve cash generation for the company. It means that Just Eat can kind of brush itself off and move forward with the kind of rest of its strategy.
Removing the overhang seems to be going down well. Thank you very much indeed, Charlotte Hughes-Morgan, on what is happening with Grubhub. Let's turn from deliveries to treasuries. Not entirely sure how you make that pivot smoothly. The former Treasury Secretary Larry Summers has warned that Donald Trump's campaign promises, including tax cuts and tariffs, will trigger more inflation.
Cumulatively, this is a more inflationary policy by far than what President Biden talked about and did in 2021. So if implemented, it will violate the Hippocratic Oath of first do no harm and will be damaging to our national economy and I suspect very damaging to a president who authors and supports such policies.
Let's talk more about what we're seeing in the markets. Details from Valerie Teitel. Over to you, Val.
Good morning, Guy. We have seen a resurgence in break-even inflation, which is the market expectation of inflation. The two-year break-even has risen nearly 100 basis points since the lows seen in September. We do get the CPI print later today. A lot of eyes on that core CPI number. Month-on-month is expected to stay around 0.3%, and there is upside risk to that reading to 0.4%. Some Wall Street economists out there noting this morning. A lot of eyes on this core CPI number and what it could possibly mean for the path of Fed rates to come. We have now just less than 25 basis points of a Fed cut priced in cumulatively over the next two meetings, meaning we could see a Fed on pause either in January or December. Not only will Trump maybe, or will Powell maybe get some heat from President-elect Donald Trump, but also bodes the question that we can maybe see rates higher for longer in 2025.
OK, Valerie, thank you very much. Bloomberg's Valerie Teitel with lots to set up the next, lots of inputs for our next conversation. We're going to talk about collateralized loan obligations now. Laura Coady joins us, Global Head of CLOs and Head of International Securitized Markets Group at Jefferies. Very nice to have you with us, Laura. So let's pick up where Valerie was taking us, which was we are expecting rate cuts. We're not expecting as many rate cuts as we were before we got wind of another Trump administration, and perhaps there are concerns around inflation out there. So what does all of that mean for issuance of CLOs? Talk to us about that link.
Sure. Well, look, let's take a quick step back in terms of what we've seen over the course of the year and in turn in recent months, because I suppose, to your point, like we've really seen quite a bumper year on the CLO side. I think in total 52 billion, and it's set to eclipse the issuance that we saw in 2021 due to the fact that we're seeing more CLO liquidations. On the loan side, it's also been an incredible year and has actually been, in terms of issuance, it has surpassed really the last 2 years. But in recent months, what we've seen more of versus kind of the refinancings and maturity extensions we've seen on the loan side, we've actually seen more M&A, and that's been incredible. Like I think October was the biggest month we've seen since October 2021, and that's been around 6 billion. Same picture in the US prior to that. So I think, look, in terms of kind of Europe, now that we have a kind of a view on the rate, on where rates are going, actually it bodes well for M&A going forward. Like as long as we kind of see like growth, some form of growth in Europe, rates coming down obviously is quite positive.
Okay.
And then, you know, look, talking about kind of, you know, Trump and a new regime, look, in a way the market's looking at it and the picture is unclear with respect to fiscal policy, with respect to kind of tariffs, with respect to inflation. That said, with kind of like changes in, with overall changes in leadership, expectation is actually M&A to continue and to grow.
So
the growth story is big.
Seat for issuance in Europe, M&A.
Absolutely,
We've heard from various voices over the last 24 hours being very bullish on the prospects for M&A. Does that extend to Europe, and that's what drives CLO issuance?
I think that's right. I mean, if you think about M&A in total over the last year, it's probably been about 30% of overall issuance. We really need to see that get back to its kind of normal average of about 50%, and that really means the picture for next year is going to be incredible for CLOs in that respect. Like, if you think about it, how big is the CLO market? It's actually about 1.25 trillion, and of that 1.25 trillion, that's housing about 70% of the leverage loan market. So expectations is into 2025 that we continue to see that demand on the CLO side.
Should I think about loans as an inflation hedge?
Yes, I mean, it's interesting that you say that, because actually, if you've seen the reaction in the US more recently over the last few days, what have we seen? The ETFs, the Invesco ETF, which is the BKLN, actually brought in 340 million in one day, right? What does that say? That people are looking ahead and saying, actually, high yield floaters is the place to be. And it bodes very, very well, actually, for kind of any sort of Trump leadership. Expectations are very positive tailwinds for CLOs and leverage loans, for sure.
If I think about where money's going to go, though, a lot of US firms are looking at the CLO market in Europe and are starting to kind of try to position for that. Does the Trump presidency disincentivize them to continue with that process and focus more on the United States? Or do you think that process continues?
I think the process continues. I think, actually, look, if you look at the investor base for CLOs, it's actually very global. So you have to think about the impact. What's the impact, effectively? What's the impact on kind of lower rates in Europe, lower inflation, that has an impact on the exchange rate, so you'll have people move from kind of US into Europe. We're always tracking where the value is, really, right? And so the big players from the treasuries, from bank treasuries, from insurance companies, pension funds, they're always looking across from the US into Europe. So I think we see continued. I mean, and the picture has been quite good in Europe, if you think about it. Like, default rates have been lower. It's always been a low growth story in Europe. As interest rates come down, that's an interesting place for investors to actually invest. So our expectation is, we look to the US. We always look to the US and kind of what's going on. Yep. And going back to kind of thematically what we're seeing in the US, actually, going back to the ETFs, one of the biggest kind of growth areas in the US has been kind of these AAA ETFs that we've seen. If you look at the Janus ETF, it's now, I think it's kind of, even in more recent days, entirely ETFs is around 18 billion. We're seeing that in the Merz side. And then in Europe, we've seen in September, we saw the first launched ETF as well. So, thematically, we're seeing people move into Europe with similar ways of investing and taking views.
Is there a regulatory overhang in the CLO space right now, or we're waiting decisions coming out of ESMA, among many others, not to mention the effect on private equity, for example? When it comes to CLOs as a financing mechanism, is that an issue?
Look, I think in Europe you've always got more regulations. When you look at kind of in particular to the kind of the ETF on the ETF side, where the US has really been the front runner for kind of building that. Europe on the regulatory side has been a little bit more muted in that respect. So it's kind of, as I said, it's not the first time that people have had to try to grow that. Look, generally, European regulation, transparency rules, being more open with docs, having kind of dual-rated structures, etc. There's typically more regulation in Europe. But that said, look, it's a great investment place for investors as we go into an environment where it's less clear, less clear in terms of direction. CLOs offer investors the ability to access like a diversified pool of obligors across multiple jurisdictions, across multiple industries, and that allows in a kind of a more because the fact that it's actually a managed product means that a good portfolio manager can access and maneuver through different market environments.
All right. Laura Coady, Global Head of CLOs and Head of International Securitized Markets Group over at Jefferies, joining us around the table to talk about that CLO market, talk a little bit about those financing conditions there and the regulatory overhang that may or may not exist over it. Speaking of regulatory overhangs, let's talk a little bit about one of the biggest deals in Europe right now, and that is the BBVA and Sabadell deal. In the last 24 hours, we heard from the CNMC this idea that the antitrust authority in Spain is saying, we need a little bit more time to review the competition around this. This is crucial. It was initially a 10 billion euro deal. This could mean months of debate about whether or not this is actually anti-competitive. Sabadell arguing this would take, of course, one of the major players and some of the kind of competitive pricing off the table. BBVA saying this actually doesn't do that simply because a good chunk of their profits, their growth, is coming out of not Spain, but Mexico. And there's a Trump trade in that.
Right. Yeah, that's really interesting, that angle on the Trump trade. I mean, it's interesting that we're talking here about a domestic deal, aren't we, Guy? And we can't seem to get to the end of those, let alone the cross-border ones that, of course, in Germany and Italy are much talked about right now.
The argument against this is concentration risk. Maybe that speaks against the idea that you want to do domestic deals. You actually want to do cross-border deals.
Ones, yeah.
In some ways, that sounds more logical if there is a concentration risk concern around this deal getting done. But if Europe is struggling to get domestic deals done with a single regulator, it does make you wonder about these cross-border deals.
Well, I think BBVA is also very interesting outside of the Sabadell deal as well, because they're doing active investment in London, but also in Germany, which is a very overbanked kind of part of Europe anyway. So the fact that they actually think they can make gains in these other European markets is pretty fascinating. Of course, they're focusing on Sabadell, but there is that Germany outlook as well.
We'll talk about Germany next and do it in more detail. We're going to speak to the author Katja Hoyer on Germany's crumbling coalition and Olaf Scholz's snap election plans. More on that next. This is Bloomberg.
Welcome back to the opening trade. 46 minutes into Wednesday's session. European equity markets pretty flat this morning, down 0.1%. On the Stoxx 600, the FTSE 100 is up 0.1%. So is the CAC and the DAX, actually. So very modest gains across Europe. Waiting for that CPI data a little bit later on. Waiting for more Trump appointments probably to come through in terms of market psychology. Let's talk about some of the politics playing out in Europe, though. The German election campaign kicks into high gear today with Chancellor Olaf Scholz making his case for another term in a key speech later on today. Let's bring in Bloomberg's Oliver Crook, who can remind us of what we're looking out for. So, Oliver, we've seen, Scholz himself calling this election. The timing has moved forward a little bit. We're waiting really to hear from the other players. But meanwhile, Scholz makes the case for re-election.
Yeah, that's right. We're going to hear from a lot of the players in Germany after this speech that we hear from Olaf Scholz at about 1 p.m. local time in front of the Bundestag, where he will speak for 30 minutes. That will then be followed by a 2-hour, very fiery debate on the sort of political disagreements that exist within Germany and really start to sketch out the sort of different positions, which we already have a sort of idea on politically going into this election. Really, Scholz, it's also an opportunity for him to use it as a platform to reiterate sort of what he says Germany needs, which is much more sort of stimulus and support for the economy, and done through basically debt financing, which is, of course, the debt break, the kind of reason that the government collapsed. But he also wants to do it in a more equitable way. He's very resistant to cutting back the social welfare state, very resistant to cutting back sort of pension reforms, coming in fairly stark contrast to what we're hearing from Friedrich Merz, the leader of the opposition, the CDU, a figure that is even more sort of conservative than Angela Merkel in those 15 years that she has as chancellor, and really going through the laundry list of things that he wants to do. The number one thing he says that he wants to sort of bring through, if he were to become chancellor, is massive tax reform within Germany. This is going to be very welcome to the sort of corporate tax front side. He also wants to cut benefits, cut pensions, cut some of the sort of unemployment benefits, that sort of thing. He also wants to cut back regulation and bureaucracy, which we've heard from probably every single German politician in the last many years. Whether or not that will actually happen is a separate question. But where he wants to win some votes from particularly the far right and the far left is a much stricter line on immigration, but also he wants to also augment defense spending from 50 billion a year to 80 billion a year, going directly to sort of building out the sort of German military apparatus, but also being much less restrictive on arms deliveries to Ukraine and basically much more permissive to Zelensky in terms of being able to strike within Russia.
Ollie, Thank you very much indeed. Perfect setup. Let's talk about what happens next in Germany and the snap election that is coming our way. Katja Heuer, Bloomberg opinion columnist and author of Beyond the Wall, East Germany, 49 to 1990. You got the book on the screen. I have to say, I've got it in my hand. The typeface, everything in this book just kind of feels like the 1970s and kind of that era. So absolutely spot on in the way that the book looks and feels, Katja. Thank you very much indeed for joining us. Look, let's talk a little bit about what comes next. How important is this election? Germany feels like it's on the floor right now. Is this election about turning it around, and can it deliver on that promise?
I think it is very much about turning it around. I think that's why the parties fell out in the first place that are currently in the coalition. They really disagreed on the fundamental way out of the economic crisis that Germany is currently in, with the Free Liberals arguing very much for kind of lower taxes, very pro-business policies, and the left-leaning Greens and the SPD in it arguing for kind of more welfare, more social stability, more investment. So there's two very completely different ways really out of the current economic slump that Germany is experiencing. So what the parties will all try and do, I think, for this upcoming snap election is come up with hopefully some fresh ideas, some distinct ideas that mark them out as political parties. Yeah. And really they need to make the electorate a new offer.
Is Germany you talk about a sort of economic crisis. Is this an economic crisis or a broader identity crisis? Germany feels like it just doesn't have a sense of direction at the moment, almost doesn't know what it's meant to be. Previously, and you hark back to previous eras, the Deutsch mark gave it a sense of identity. It imposed discipline on German business. You look at what is happening with immigration in the country, and that seems to be undermining maybe the case that many people feel about German identity. Is this beyond economics? Is this about something bigger, about what Germany actually is?
Well, I've as a historian, I've very strongly argued that Germany's had this identity crisis pretty much since it became a country in 1871. Mainly, I mean, one of the big issues that we see with the war in Ukraine as well is that Germany still, I think, to this day, isn't entirely decided as a nation whether it is indeed a fully sort of Western country in the way that, say, France or Britain or the US are, or whether it looks east just as much. I mean, you could go back to Otto von Bismarck, the first German chancellor, but also as recently as Angela Merkel, arguing that there should be swing politics, as she called it, looking both east and west. And I think that's one of the fundamental issues behind people's disagreements over the war in Ukraine, with the sort of more east-looking people arguing that this is due to Western aggression, and people who are the traditional Atlanticists saying, no, we need to support Ukraine because this is really supporting the West against Russian aggression. So I think these fundamental issues are there, as are kind of issues around what sort of economy Germany wants to be. So after the war, you had the social market economy model basically as the main driving principle in West Germany, but globalization, deregulation, and so on have sort of questioned this over the last few decades. And I think, again, there's a fundamental difference there between the economic models that people want to build up, on the left and the right of the political spectrum.
Talk to us a little bit about some of those policies, though. I mean, this coalition really came apart over a debate, among many other issues, around the debt brake and whether or not Germany should change some of their approach to that. Katja, what are the implications of that removal?
I mean, the debt brake is really at the heart of all of these kind of bigger issues that I was just talking about. So the idea that Germany is basically a fiscally responsible country, that's why the debt brake. So the idea that Germany can't borrow a lot of money on top of kind of normal expenditure is part of the actual constitution of Germany now. So most of the political parties across the spectrum have agreed to that and are basically okay with that. Whilst most other countries, I think, would look at that and think this is very much a sort of political and economic straitjacket because Germany then can't spontaneously respond to things. So say Friedrich Merz, as we've just heard, wants to increase military spending significantly. Without loosening the debt brake, this will have to come out of somewhere else, out of other kind of areas of policy making. So probably out of welfare spending or out of sort of subsidies into the industry. And you basically end up making political decisions for economic reasons that will cut back somewhere somewhere else rather than borrow and invest, from sort of outside sources. So those are all big fundamental issues about the kind of model that Germany wants to take forward.
So, Katia, you don't see then the debt brake as up for debate here? I know that it is constitutionally set, but some have talked about whether there might be ways to get around that. Do you see that as important to the conversation, or are there ways that Germany turns itself around even with the debt brake in place?
I mean, it can turn itself around with that in place. We've seen this with the special military budget that was put in place after the invasion of Ukraine. So basically, you can declare something a special budget and argue the case that this should be exempted from the debt brake. But it has to be quite a strong argument in the direction, that this is an emergency, something that needs to be sorted out immediately. It's also a fact that the parties who are currently most popular, particularly the CDU, the Conservative Party, they don't want to loosen it. And so basically, I don't think that is going to happen going forward, because you would need quite a broad political base really to change the constitution in that direction, which I don't see, going forward, that there's that much unity in Parliament. So I don't see that changing. But what might change is that they argue on particular issues that there should be exemptions, and then maybe you can get a parliamentary majority for that rather than fundamentally loosening the debt brake.
All right. Katja Hoyer, Bloomberg opinion columnist and author of Beyond the Wall of East Germany, 1949 to 1990, joining us this morning to walk us through some of those implications around the German election set, I believe, on the federal front for February 23rd. Let's talk about what else is going to come up in the next 24 hours. Of course, all eyes this morning on the U.S. CPI print. The estimate is about a 2.6% year over year. I should remind everyone that the prior was 2.4%. So if we get that survey number, that inflation tick up that we've been warned about, actually manifest.
Yeah, there's some sticker shock value there, I suppose, although, I mean, it is widely expected. It's on the Waco screen on the Bloomberg terminal, so it shouldn't come with much of a surprise attached, should it? But we are expecting that uptick in inflation. And, guys, we were talking to Rachel earlier on in the programme. Yes, it's very much about the here and now, and the focus of markets is really around Trump and how inflationary he might be in his second term. But she says because this pushes in the same direction as that, it sort of links in with that broader, more medium-term narrative.
What's really interesting here is that gasoline prices have come down. Energy prices have come down pretty sharply in the US. So in many ways, you would argue that the traditional drivers of inflation are not there. This is service-side inflation. And it's going to be interesting to see how the administration, can it offset higher inflation over here with lower inflation over here? And is that how the energy policy is going to be set up in the States? Yeah, it is, yes, exactly that. Is it going to be the offset to the tariffs? Yeah, that would be an interesting one to watch, no doubt. A lot more detail, a lot we don't know about the way that incoming President Trump will want to implement his desired policies. Coming up later today, don't miss our interview with the Minneapolis Fed President Neil Kashkari. That's at 1:30 p.m. UK time. European stocks then flat to positive this morning. US futures flat to negative. That is it for the opening trade. The pulse is next. This is Bloomberg.